Thanks very much, Poonam, for giving us those details. Let's get in a sense as to what the brokerage community has said about the bank. You've got Credit Suisse, which maintains an outperform in a 660 rupee target price. They say that the healthy growth is supporting the company, and that has helped improve the profitability. Capital levels are strong. They increased the EPS by 2 to 3%. CLSA too maintains a buy rating, and they've upped their target price in 800 rupees to 825, saying that the normalizing profitability will drive valuations. The domestic growth of 18% on a year-on-year basis helps the bank emerge as a new growth leader and the best provided stress from a second wave. Motilal Oswal maintains a buy with a 750 rupee target price, saying that asset quality has improved, higher prudential provisioning provides a lot of comfort, and that the strong business performance as well as margin expansion has helped the overall business performance. In fact, there's been strong operating performance aided by the NII growth. Let's connect with Santanu Chakrabarti as well from Edelweiss Financial Services to talk a little bit more about ICICI Bank's earnings. Santanu, wanted to get in a take as to how you're looking at the overall numbers, but more importantly, the higher prudential provisioning. Do you think that this provides quite a bit of comfort on the number front?
Right. I mean, obviously a very strong set of numbers in line with what we had expected actually at the operational level, other than minor, disappointments in treasury income. So the provisioning that they have made towards COVID in this quarter is about 1,000 crores. And the total number has gone now close to about 8,000 crores on discretionary COVID provisioning. If one adds up all their excess provisioning vis-a-vis the amount of assets which were irregular in any form or shape over the last 12 months, one can see that as long as the current stress does not extend beyond, say, 4 or 5 months, if the whole thing can be bundled up within a reasonable amount of time, one would have to agree with the management's assessment that the impact on balance sheet is a lot more muted, and that problem is a lot more of a capped problem versus the kind of open situation one would have seen about a year back, where the uncertainties were far higher than what we are seeing now. That uncertainty was in terms of, how long it could go on and whether there was, light at the end of the tunnel and when that was, etc. While current uncertainties are basically operational in nature, even though the intensity of infections, etc., are higher. So once that distinction is made, I'll have to agree with the management's assessment on adequacy of provisions. And one more thing I would point out regarding that adequacy of provisions number, that if, there wouldn't have been a second wave, and instead of this 1,000 crore of addition to that, one might have easily seen about 1,000 to 1,500 crore kind of unwind of that same provisioning stock. And just understand that would have meant about 1,300 to 1,500 crore extra PAT in the quarter, and that unwind would have provided a further tailwind to profit for the next 4 or 5 quarters for sure. Now, that trade will happen. It's just that with wave 2, that part of the story probably gets pushed out by a quarter or 2, but it does remain. And on provisioning, therefore, we see absolutely no worries whatsoever.
Yes, and the management did say that the COVID-related provision is comfortable at this point. Do you believe, Shantanu, that the normalizing... Okay, we'll let you go on that note, Shantanu. Thank you for joining in and sharing with us that outlook. Let's slip into a very short break. Be right back.